Any system you build, especially when it comes to investing, has to have rules. They give you structure, they keep you disciplined. But what happens when those rules, the very ones designed to keep you safe, actually stop something incredible from happening? That's what we're digging into today, when good rules need to bend.
And this is really the heart of the matter, isn't it? Sticking to a system is great for avoiding emotional blunders, but if you're too rigid, you could end up selling your biggest winner way, way too soon. The best systems, well, they have an escape hatch, a really disciplined way to handle those rare, exceptional cases.
All right, so here's the game plan. First, we're going to tackle the main conflict, what we call the 100-bagger problem. Then, we'll build a framework to solve it with 5 very specific criteria. After that, we'll see how this whole idea impacts how you manage your portfolio, and we'll wrap it all up with a masterclass from one of the greatest investors of all time. Okay, let's dive right into the problem that every single systematic investor runs into if they're lucky enough. It's what you'd call a high-class problem for sure, but it's still a real problem. What in the world do you do with a stock that just won't stop winning?
And here is the really uncomfortable part. Looking forward, a future 100-bagger, that's a stock that goes up 100 times, it just looks like another good idea. But looking back, oh, it seems so obvious. Everyone says, of course Amazon was going to take over the world. But back then, nobody knew for sure, and there were a million reasons to sell along the way.
So you're stuck in this massive dilemma. On the one hand, if you have a strict rule, like say you sell after a stock triples, you lock in a great return. Awesome. But you totally miss out on it becoming a 100-bagger. On the other hand, if your rule is to never sell, well, the 96% of companies that don't become titans are just going to drag your entire portfolio down. It's a real catch-22. This is the million-dollar question, right? If you can't predict which company is going to be the superstar, how do you possibly build a system that lets you catch one without getting totally wiped out by the ones that fail? It feels like this system is trapped. Well, it turns out the answer isn't about getting better at predicting the future. It's about recognizing when a company has proven itself. The solution is to create a special status, an exception, for companies that have shown through thick and thin that they are truly in a league of their own. They literally have to earn the privilege of breaking your rules. So how in the world does a company earn this right? That's what we're getting into right now. We're going to lay out a very specific 5-part test to figure out which businesses actually deserve to be called untouchable. Now, to really get this idea, let's use a great analogy, the coffee can. It's a simple concept that goes way back to the Old West. The idea was you take your most valuable things, put them in a coffee can, maybe hide it under the floorboards, and then just forget about it. No touching, no trading, no tinkering. The logic here is that for a truly great compounder, the single biggest risk is you, the investor, who just can't resist meddling. But, and this is so important, let's be absolutely crystal clear. This is not a strategy for your entire portfolio. A coffee can full of speculative stocks? That's just a recipe for disaster. The coffee can is a special status, an honor, that's only given to the absolute best of the best, the ones that have proven, beyond a shadow of a doubt, that they deserve to be left alone to compound.
Okay, so here are the 5 massive hurdles a company has to clear. Number 1, invariant ROIC. ROIC is just return on invested capital, a fancy way of saying how good a company is at making money with the money it has. This means it has to generate high returns not just when things are great, but through recessions, rate hikes, you name it. 2, frictionless reinvestment. The company can plow massive amounts of cash back into itself and still get those high returns. Its runway for growth just seems to go on forever. 3, the moat paradox. This is a cool one. It means the bigger the company gets, the stronger its competitive advantage becomes. Think of a social network. More users make it more valuable. Size is actually a benefit. 4, non-existential volatility. Yeah, the stock will have some scary drops, but a 30, 40, even 50% fall won't kill your portfolio. And finally, number 5, inverted asymmetry. This is the point where the risk of selling, think about taxes, finding something else to buy, missing out on future growth, all of that actually becomes bigger than the risk of just holding on. And the key is a company has to check all 5 of these boxes. This isn't a 3 out of 5 ain't bad kind of deal. But when it happens, when all 5 criteria are met, that position has officially earned untouchability. The normal rules get suspended. The lid on that coffee can snaps shut, and you let it do its thing. So, we have the theory down. Now let's get practical. How does this whole concept actually play out when you're managing a real portfolio? What happens when one of these untouchable stocks gets, Gigantic.
This right here is what we call the rich person's problem. I mean, look at this. Your portfolio rules might say, hey, no single stock should ever be more than 10%. But because of its incredible performance, one of your untouchables has ballooned to become 50% of your entire net worth.
So what does every investing book on the planet tell you to do? Trim it, rebalance, take some profits off the table, and get back to your nice, neat allocation targets. But if this company has passed all 5 of our tests, is that really the smartest move?
And here's the most critical point of all. If a stock has earned that untouchability status, that status gives it veto power. It can literally override your normal rules about allocation. The fact that it's now 40 or 50% of your portfolio isn't a problem you need to fix. It's the result of the very exceptionalism you wanted in the first place.
This completely flips the script. The question you need to ask yourself totally changes. It's no longer about hitting some arbitrary target. It's all about survival. You stop asking, is this position too big? And you start asking, if this incredible company had a horrific 50% crash tomorrow, would I be okay? Would I still be in the game? If the answer is yes, then the exception holds.
And to really bring this all home, there is no better case study than Warren Buffett. He is the absolute master of letting his winners run. But there's a really important nuance to how he does it. We've all heard this famous quote, right? It's the ultimate mantra for long-term, coffee can-style investing. It perfectly captures that spirit of just holding on to wonderful, wonderful businesses. But this is exactly where a lot of people get it wrong. Forever doesn't mean you hold on blindly no matter what. Buffett is a pragmatist. He absolutely sells. The real key is understanding why he sells. See, he doesn't sell because a stock went up, and he's not locking in a profit. He sells when the risk profile fundamentally changes. I mean, think about it. He dumped all his airlines in 2020 because the pandemic was an existential threat to the entire industry. He has trimmed his Apple position, not because it's a bad company, but to manage the massive concentration risk it poses to Berkshire. And he gets out when the original reason he bought the company, the entire thesis, is just broken. It all comes down to managing the risk of ruin. So the Buffett nuance really sums this whole idea up perfectly. You hold your untouchables, you let them compound until something fundamental about the risk changes. And look, if the Oracle of Omaha himself trims his biggest winners to manage risk, then nobody should feel bad about doing the same thing when it's prudent. And that really brings us full circle. This whole framework for making exceptions, it's not a loophole. It's not an excuse to get emotional and throw your system out the window whenever you get nervous. It's the exact opposite. It's a higher form of discipline based on strict evidence-based criteria for when a company has truly, truly earned the right to be treated differently. So I'll just leave you with this question to chew on. Take a hard look at your own investing process. Your rules are there for a reason, and I'll bet most of them are doing a great job protecting you from making big mistakes. But is it possible, just possible, that sticking to every single rule no matter what might be the one thing that's preventing you from capturing a truly extraordinary, life-changing return? It's something worth thinking about.